Hi there, a very good morning and good afternoon to all of you, depending on wherever you're watching me. This is Simply Stocks, and here I am live in this live session with you all. So, let me have a look whether the session is going fine or not. Another tutorial session that I have with you all, and hopefully, we are going online on stream right now, and hopefully more people should join in so that we can begin the session in earnest. So let me have a look whether the session is doing fine or not. uh, and if you can hear me and see me properly, kindly do message me for that as well, that video is streaming fine. So I want to just have a look on my mobile phone, and then we'll get things started in earnest. uh, all right. So basically today I'll discuss about what all goes through when we analyze sector valuations, and how things go about. So as I see, the streaming is going fine, and we are doing fine with the streaming part. So we get things going now. Basically, point here is what I'm going to do today is that I'm going to give you an idea as to uh, how do sectors basically behave, and what happens in each sector. What is an average sort of a PE that people maintain, or the companies maintain, and why do these PE ranges differ in each sector? So we're going to discuss that one by one as I go through. So hopefully you'll like the video. Kindly do like and do subscribe to my channel. And also, if you are if you want to know more, discuss with me one on one with messages, you can definitely become a member uh, on Patreon, on YouTube, as well as on WhatsApp, and yearly membership there, and you can have direct discussion with me on topics of stock market, and also on different stocks. You get watch list and many other calls also on a weekly basis. So before I get this session in earnest, it was a very difficult, you can say, a week in terms of sports for us. We lost in the Hockey World Cup to New Zealand in the playoffs, which was really not called for, and something that was extremely, you can say, disappointing. And we should have made it at least to the quarterfinals, played Belgium, and probably we would have seen as to how things would have pan out. But eventually we lost. Now, in terms of hockey, what we have is the FIH Pro League, which begins again for India from March, although matches begin from next month, but India play in March. And then we have the women's FIH Pro League in later this year. So that's in hockey. In cricket, we lost again in a T20 against New Zealand, and we lose a lot against New Zealand. And probably we lost 3 wickets in the first 5 overs, and that was something uh, due to which I believe that things went awry, and eventually we could not make it. Arshdeep had a very bad last over. He had a very up and down last over against in the World Cup as well. So he needs to get things in order. He is a key player for us for the World T20 in the West Indies next year. So we will see that. So another second T20 international is today. So let's see how things pan out there. Apart from that, in tennis, we have seen the women's singles final that has already taken place. So uh, that went well. We had a lot of, you can say, a three-set final that we saw, and Sabalenka winning that. So overall, in terms of performance and everything, uh, uh, the match was good, and today Djokovic will be in action, so looking forward to that as well. And the under 19 World Cup final is today, so that's a big one. That India faces England there in the women's under 19 World Cup. So looking forward to that as well. So let's begin the session, and let's begin the session by talking about what is happening in the market first of all. So let me open up, and if you can see my screen, kindly do message me, sharing the screen here. Let me open up the Nifty per se, and we'll discuss about that. So uh, currently what has happened, I'll discuss Nifty, and I'll discuss about the BSC small cap as well uh, in this complete session. So if we look at Nifty, and let me open Nifty in the uh, you can say Nifty 50 on the money control website, that gives a kind of a better idea as to where the market is headed and what is happening. So we are at 17,600, and I'm not discussing much into the Adani issue because you would have probably heard about it and watched a lot of videos in detail as to what is going on. Basically, I'll discuss about the markets, and if you can see here as to how the charts are panning out for the Nifty, we are seeing that currently we are at around 17,500 or so, and we got support around 17,500. These are strong supports around this region of 17,500. But if that goes, then you should start looking at 300 point ranges. So what we are looking at right now is that if 17,500 goes, then we are looking at 17,250. If you see here closely, in September of 2022, we were around 17,300 or so, and eventually we had a gap down towards 17,170 or so, 17,190. So we could be headed between 17,190 to 17,300, around that range. I believe 17,250. Below 17,500, we could be headed towards 17,250. But if you see closely speaking, then we are in a situation where I won't be surprised if we see 16,800 or so. So we could be in a situation where 600 to 800 point decline could be possible if this fallout really escalates, and things really go bad, because one or two stocks of theirs are in the Nifty of the Adani group, and things can get bad. So get ready for 16,800 on the Nifty. I think that is a distinct possibility on the Nifty. That is the worst case scenario. The best case scenario is that we don't break 17,500 and stay here, which doesn't look like. And if things really escalates completely and blows out, then we are looking at a situation where we could be headed towards levels again of 16,000 or so. So 16,700, 800, which was a peak in June of 20, I think June of 22. And in that rally, after the decline, it went there. And then the decline in June, and the decline that took place around that June period was around 15,000. So if 16,700, 16,800 goes, we are looking at 16,000 levels. So there could be seminal 300 point decline continuously, which could take us way back to 16,000 levels if things really escalates completely. Otherwise, we could probably gyrate in this 17,300 to 17,700 band and absorb everything here. I hope we do that. It doesn't look like, but I hope we do that. So in my opinion, what could happen is in the next month we could see 16,700, 800. We have the budget and a lot of triggers, and eventually will bottom out. Remember, I have talked about valuations a lot of times, so let me open up the calculator here. I believe that FY24 we are going to see earnings for the Nifty around 960 rupees. Now if we take 16 times, we are looking at 15,400, which was during the war, just after the Ukraine crisis. We were around here when the decline happened. So we were trading at around 16 times. Now if I say 16,700 could be the level we are looking at, then we'll be trading at 17 and a half times, which is pretty reasonable. I won't say very cheap, but reasonably valued market. Normally, Indian markets rotate around 18, 19 times earnings. So around 17 and a half times, people will flock to buy into top quality companies. So I believe in the next 1 month, market should see a long term bottom, and people or large investors will come in to buy into clean, very good debt free companies. And hopefully around these levels we will see some bottom. If we go to 16,000 on FY24 earnings basis, will be around 16 and a half times, which will be very attractive. So I don't see the market going below 16,000. That's 10% from here, 8 7 8% from here. I don't see the market going above 18,000 anytime soon. So probably if you get a chance to have Nifty around 17,000 to 16,500, start buying. If you are a very short term player and you are looking to probably trade into the market, and you're looking at a situation where uh, you believe that you cannot take losses, you should book out right now. And probably what you need to do is buy into the market on some sort of a decline. I see 5 600 point decline happening in the market. So if you are a very short term player, then be ready with some cash. So get some cash, and taking positions off is a better thing to do if you are a 1 month player or so. Otherwise, one should look at holding on to the stocks, and over the next 2 years the performance should trickle through, and you'll be able to make money over a 2 3 year time frame or so. So that is my opinion on the large cap index, or the Nifty, as to how things are panning out. When we consider the small cap index, and that is where I'm moving to now, on the money control website. If we look at the small cap, because people do invest into, and right now retail investors are invested into smaller mid caps or small caps. The small cap index has taken support where I have talked about last week, which was around 27,500. But the charts are not looking that great. If you look at the charts are not that great. From around 29,200 levels, we have fallen from say 4th of January. So from the start of this month, we have fallen more than 10%. I think around yes, around 10% or so in the index itself. So there is no surprise that our portfolios are down big time from the start of January, when things were looking much hunky dory. But if you look at a, say, a 3 month chart, then your support lies around 27,200 or so. That's where your support lied, and that's from where the market came back on Friday from 27,300 on the small cap index. Now I see, if things really go bad on the front of Adani, then I see that getting broken. And if we look at a 1 year chart, if we look at a 1 year chart here, uh, then you see an intermediate top again in June to be made around 26,800. So the market could try to find support between 26,700 to 27,200. And if it doesn't do that, then we are headed much lower. I think we are headed towards something like probably, if I can just make this into if I can just expand this, you'll be able to look at it better. So basically, if you see here, so 26,800 900. So basically what will happen is next 2 3 days in the trading session, if the market stabilizes, then we won't go below 26,800. So that's around 2%, 3% down from here. But I believe we are going further down even on the small cap index, and probably will find support in the range between 24,700 to 25,200. So around 25,000 is where we'll find support in the small cap index. That's what I feel. I believe that in the coming months, you'll have a situation where the market could go down another 10% in terms of the small cap. The market could go down another 3 4% in the large cap. So that's the basic crux, that the large index could go down 4 to 5%, and the BSC small cap could go down 10%. Your stocks, my stocks, because I am also invested into smaller companies, could go down, if you are invested into small and mid cap, could go down 15% or so from here, because the stocks fall even more. So don't be scared, analyze your companies, look at where your companies are, look at how their performance are, and then think about whether you're going to hold it for the next 2 years or so. Because thing is that now it's going to be at least a 1 year hiatus for us to make big money if you are invested into smaller companies, because uh, this whole cycle will take a decent amount of time for the market to probably come back into fashion again. So that is my call. Hopefully you would have understood as to why I believe, and I have talked about it a couple of weeks back, that the market doesn't seem like headed higher, doesn't seem like headed towards say levels, and any level, say closer to 18,500 or so, and we it seemed like that we'll be in a range between 17 to 18,000, and the reasons came out later on. uh, so that's my point. Hopefully you will understand as to uh, why I believed that the market is not headed higher. So hopefully now you will understand as to where the market, in my opinion, is going. Now let's come to the point what I wanted to discuss, and this is more about as to what I feel is the reasons are the reasons as to uh, why the market gives different PE to different sectors. So that's my analysis uh, that I have come up with, and I'll discuss each sector with one example. So this is going to be a decently long session that we are going to probably talk about in here, but hopefully you'll like it. So let me just start with the small PPT that I have made, or small one slide that I have made just half an hour back, because this is an understanding that I have made over the last 11, 12 years, and these are averages for the valuations of each sector that I believe the PE ranges for each sector. So let's start with the consumer oriented sector, or the consumer sector. So most of the consumer stocks, or consumer oriented stocks, trade between, or new age IT, etc., and all, trade between 50 to 150 times. And this is not a phenomena of just last 2 3 years, or I'm sorry, just last 3 years or 4 years. This has been a phenomena for the last 15, 20, 30 years. uh, I've checked the historical values for most of these companies which were listed earlier as well, say the Unilevers, etc., and they also kept on trading at such valuations. So one such example is DMart, even with abysmal results last time around of a 6% growth. If you look at DMart, uh, then the quarterly results were not that great. In December 22, they had sales of say 965 crores or so, and in December of 2021, they had sales of 886 crores or 866 crores. So just a 12% increase in you can say 12% increase in profit, sorry, profit of 965 versus profit of 866, and margins dropped to around 8% from around 9% in the last year. And yet the stock did not fall a lot after results, although before results the stock fell. So eventually the profit in 2021 December was 420 crores, whereas this time around it was around, you can say, the profit in December was around 550 crores, and the profit this time around was 590. So only a 15%, only a 6-7% increase in profitability. And yet if you look at the stock price, the stock started falling from say around, what it was around September or so last year, and has fallen a lot. Yet I believed that after results stock should have fallen more, but stock bottomed out. Probably it was sell on rumor, buy on, you can say, final news. But I believe that even current valuations, if you look at it currently, it is trading at 98, 99 times earnings. So this is exactly what I meant, that most consumer centric stocks, which are direct consumer plays, staple plays, say all these, you can say malls, and all these kinds of supermarkets, stores, or you have Britannia's, HULs of the world, they trade at worst 50, 60 times, at best 140, 150 times. Now if you look at the PE range for Avenue Supermart, that is DMart, for the last say 5 years, or for the last 3 years, because it has been listed for the last 3 years, it went to a peak of in October, or let's come back to say January, or let's say October 21, because the market made a high, it went to a PE of 300 times. It was trading at 300 times earnings, and on an average it trades at around 160 times. This is exactly what I meant, on the higher end of my range, what I explained, 50 to 160 times. So this has a long way to go down, in my opinion, if you ask me stock specifically, uh, in something like a DMart. But I have a feeling that going forward, you'll have a situation where the stock could stabilize around 3,200 or so. But that is about the stock. Basically what I meant was, these companies do trade between 50 to 150 times. So kindly take that on note. Whenever a stock is closer to 50 times in the, you can say, consumer space, it is better to get into it if the company is growing decently. Second is IT. 20 to 40 times is at best, I feel, IT stocks rate. Now there are two types of IT stocks: large cap IT and mid cap IT. And normally what has happened, apart from the pandemic situation in 2019-20, apart from that, uh, during say before that, we have seen IT stocks trade between 15, 16 times to 30 times. Basically that has been the range. It has not even gone beyond 30 times, 32 times. But after the pandemic, and with things cropping up on the IT side, and we have the EV segment coming in, we have the driverless vehicles, and many companies going into it. At least one company is into it big time. And we have animation, we have other kind of products coming in which IT is a huge need in day to day life today. I believe that IT stocks can trade at 35, 40 times at best. So what one needs to do here, why I'm trying to explain these to you, basically so that you are able to understand whether a stock is extremely expensive or extremely attractive. So currently the IT index itself is down 30% from the top. So in my opinion, if there is a possibility for any IT stock, now here I have picked up, if I see, there's KPIT at one domain. And let me see which other stock did I look at from the IT space. I have not looked at any other, so let me open up uh, a large cap on the screener, so that you have an understanding, or a smaller company uh, in which there has been a decent decline. So KPIT will do, but let me just open up, for example, Birlasoft. So in Birlasoft, we have seen a seminal decline in the stock at typical IT company providing IT services. Now it has an ROE of around 25%, around 20%. The stock is trading at a PE of 16 if you see here. Okay, now the stock has fallen from around 500 rupees all the way to 290 rupees, and the decline has been big time. Now, for example, I extrapolate that 500 rupees onto the current EPS that we are looking at. So we are looking at uh, see, the December numbers are not out. So let's look at March 22 numbers. It's around 16 and a half. So let's say 17 rupees EPS. And we say 510 has been the peak, just to help analyze in a better manner. So we are looking at 30 times. So the stock was trading at 30 times at its peak. And now it is trading at somewhere around, if I take 17 rupees as the EPS and 290 as the current price, 17 times. So from 16, from around 30 times we are down to 16, 16 and a half times. And this is where I believe that one needs to understand that if an IT stock is trading at 30, 35 times, mid cap IT tier stocks growing at 20%, a simple company that is providing IT services, not extraordinary, then and having an ROE of around 20%, trading at 30 times, you need to be careful. If you have a very short term time frame, then you need to probably book profits. Now, a second part of it is because there are many IT companies that are listed, it's very difficult to analyze as to very difficult to have one average for each. If you look at KPIT, for example, KPIT is trading at around 60 times. It's going to come out with numbers in a couple of days time, 2 3 days times. uh, but if you look at its PE range has remained high continuously for a decent period of time. From say June, July of 21, it has been trading higher. Why? Because it is into domains which are uh, more exclusive in nature, into EV segment, into vehicles, into providing, you can say, electronics for vehicles and all. So things are different in KPIT, and here again ROE is similar around 20 21%, but since its growth has been phenomenal in terms of profitability, that's why in IT stocks, in these kind of companies, things are looking much different. If you look at profit in September, it had a profit of around 84 crores. If I look at it consolidated numbers, if you look at it closely, 84 crores versus say September of last year, which had around 65, so around 30% growth. Here we are seeing 30% profit growth. In Buildersoft's case, we are seeing 18 20% profit growth. So that is why the stock is trading at 60 times. But I believe normally a stock trades double to its profit growth. So if the profit growth is 30%, the stock at most can trade at 60 times. Now, where lies the risk? In terms of KPIT, the risk lies that if the growth drops, if the next quarter numbers in a couple of days time comes out and the profit growth is say around 20 25%, the stock could very well correct 10 to 15% from here. So this is where you need to be careful if you are a short term player, that probably if you really want to, you can book profits or book out even at some loss, and take a call after the results are out, or after you have seen that how the results have panned out. If you're a long-term player, yes, if the growth is slightly down for 1 or 2 quarters, not an issue. But if continuously the growth comes out to be 20 25%, the stock will start trading at 50 times, 45 times. So that's the call on the IT pack or the IT part. So basically around 16, 15, 16 times most of the stocks were trading at. Those were the times to really get into the stock. Even now, this is a very good time to buy into IT, and that is why most of the experts are talking about buying into IT from you can say a 2 3 year time frame. Now come to the reality stocks, or stocks that are into the real estate domain. Normally they trade between 10 to 30 times. uh, in the best of the situation, they trade at 30 times. Many of the real estate stocks are producing losses, so you cannot probably analyze them in that manner. Let me just close KPIT and even Buildersoft for that matter, so that I'll be able to locate the reality stock, one of the real estate stock that is under owned at the moment and has gone down sharply from the top is NBCC. Now, this is a typical example because it is a slightly debt free, very less debt company, government, you can say orders they get, very decent company in this space. Now, it is trading at 19 times at the moment at around 35, 36 rupees. This is exactly comes into our domain of where reality stocks should be trading at between 10 to 30 times. So it's not expensive, not very cheap, not very expensive. Now, if you look at a 1 year chart of the stock, it fell to in June of 2022, it fell to around 27 rupees. Now, if I look at the numbers for FY22, it had an you can say an EPS of around 1.25 rupees. We are expected to see further EPS growth this time around, but if I extrapolate 28 rupees, if I take 28, which was the low in June, and take it on a 1.25 rupees EPS, let me see what sort of a number we end up being. So we are looking at something like 22 times. So at its bottom, it was trading at 22 times. That is 1 year back numbers. So if I extrapolate the numbers for FY23, normally the growth is around 25% or so. If I take that, then we are looking at somewhere around 1.6 rupees EPS for FY23 or so. So in terms of EPS growth, we are looking at 1.6 rupees EPS, 25% growth. And if I extrapolate that on 28 rupees of price in June of last year, then we were looking at 18 times. The stock was trading at 18 times. So again, the stock is trading at 18, 19 times. Again, not expensive, not very cheap, but these stocks do not trade at 30, 40 times. So what is the reason for that? Why are, you can say, real estate stocks do not trade at higher valuations? Why do they trade at such low valuations? There are a number of reasons. Number one is, and if we compare that to IT or say a consumer stock, why the reality stocks trade at such low valuations? You can put your answers in the comment, but I believe that there could be two three reasons for the same. So I feel that the number one reason for this is that uh, real estate business itself is a high gestation period with debt involved in it. So if the interest rates goes up, then there are problems for real estate companies. So you don't know that whether whatever earnings that you have envisaged or are analyzed for the next 2 3 years, whether the same amount of earnings or same growth earnings growth will be there, because there are a number of external factors that work. Second, there is a lot of government interference in the real estate space. So that is why your PE shrinks, because government could change laws, and there could be other, you can say, announcements coming in that could impact the numbers altogether. Third, there is a lot of issue with demand supply thing, and so since it's a high gestation period thing, then you don't know whether the projects will get executed on time or not. So in that sense, you don't understand that whether there'll be a streamline of, you can say, cash flow coming in. That is the fourth reason, that cash flow is extremely less for these kind of companies. NBCC is a, you can say, an exception, but there are many companies that work on high debt, and so cash flow is less. So there are three four reasons why in you can say real estate you won't see companies normally trade above 30 times, whereas in consumer centric cash companies where they work on cash and all HULs and Daburs of the world, you will see them trade at 50 60 times. So that's about the real estate companies altogether. Let's understand what is the next, you can say, in the list. Next is pharmaceuticals or agrochemicals. Now, this is an interesting fact if we look at pharma and agri space. Uh, let's look at Loras for the pharma thing, and we'll see Coromandel for the agri space. So, Loras Labs, for example. Now, why I picked Loras Labs is because it is down from the top and now at reasonable valuations. That's why I have picked. If you look at its EPS and everything, it's trading at 22 times earnings. Normally, pharma stocks, which I have analyzed over the last 10 years since the pharma industry has picked up big time over the last say 10-year period, normally these stocks trade at around 20 to 25 times, 18 times, 17 times, at and agrochem companies trade at between 10 to 15 times. That's why I said 12 to 25. If I bifurcate this, then pharma companies trade between 20 to 25 times, and agrochem companies trade between 10 to 20 times. So that's the call. uh, Basically what happens is, why do they trade like this, is because pharma as a space, they are generic company. They make medicines and formulations for export to US and Europe. They don't direct, they are not brands. they, Most of them not are not. Some do sell their brands and their products and all, but most of them produce products for US, European, or you can say South American companies. So what happens is, they sell them to these brands, and these brands sell the products direct to the consumer. So this is a B2B business. If it was a direct consumer type of business, then these valuations which we are talking about, being 20 to 30 times, would have been something like 50, 60 times. So that is why most pharma companies, even if they are the best of the pharma companies, trade at 30, 35 times. If I open up something like Dr. Reddy's at this point of time, then we are looking at it trading at 20 times. It's not even say 30, 40 times, and it's one of the best in this space. If I open up say Sun Pharma, for that matter, which is an even bigger company in this regard, it's trading at 31 times after the decline. So what I feel is that at best, the best of the best pharma companies trade at 30 times because of the reason that I explained, and most of the companies trade at 18, 20 times. So when you see pharma stocks trade at 35, 40 times, be extremely careful. When you see them trade at 20 times or under 20 times, that's where you need to really pick them, and you need to analyze as to how the valuations are stacking up from a 2 year point of view. In terms of Loris Labs, for instance, I believe it's trading at 18, 19 times 2 year forward, and that is why it is attractive right now compared to what it was say during Holi. I remember it was trading at 600 odd, yes. So around that time it was trading at 600, as we see here, and the stock has declined so much. So most of the factor for the decline in the stock is because of the results that have gone down, but there's another factor of PE contraction that take place after a period of time. So that's about pharma. Let's look at agrochem. And an example in agrochem is Coromandel International. Now, Coromandel is trading at 13 times at this point of time. At its peak, now let me look at a PE ratio chart for it, and that's where screener really helps. Around say when the market was doing extremely well, and this is the period around Jan 21, even then it was trading at around 18, 19 times. It wasn't trading at extreme valuations in June, when the agri season really comes up. It was trading at 20 times. So at best, it is one of the best companies in the agrochem space. It trades at around 20 times, and as I said, now it is trading at 13 times, looking extremely attractive. That's why this was one of the calls in one of my videos, that Coromandel can be bought from a 2 year point of view, because now it's trading at 13 times. If I forward these earnings to say 2 year forward earnings on a 2 year basis, we are looking at a situation where the stock could be a big performer, 50-60% up it could go, simply on the fact that the growth will be there. If you look at the numbers, you look at the September quarter numbers, we have seen 10,000 crores of sales versus 6,000 crore, big jump there. 10%, so the margins have dripped, but overall numbers have gained a lot because there has been a jump in the sales front. So 740 crores has been the profit versus 500 crores, a big jump in terms of you can say profitability of 35%. So a company growing at 25-30%, trading at 13 times, cannot be the normal, and there should be a PE expansion here, and that's why Normally agrochem companies trade between 10 to 20 times or so, and this is trading at 13 times, looking good. Let's see which is the next sector that we are going to look at. So autos, autos is interesting. It trades between 25-30 times for direct auto consumer players like Bajaj Auto, etc. They do trade at 25-30 times, but we have more auto ancillaries that are listed. Auto ancillaries like Jamna Auto, Motherson Sumi, etc. So let me just open up one auto ancillary as well here by opening up the screener website. So if I open up Jamna Auto, for instance, let me just give you an idea on an auto ancillary, a decent auto ancillary which has an ROE of around 22, etc. It's trading at 24 times at the moment. Current price is 104. So basically, these companies do trade at around 20 times or so. They don't trade uh, at a lot of say higher valuation more than 20-25 times. Before I come to that, I'll just explain as to why agrochemicals trade at only 15-18 times. Basically, they are seasonal in nature. They have a lot of issue with respect to how the monsoon pans out, how the demand is, how the crops have done, and all, how the rural income has been, and that is why uh, there's a lot of effect on their you can say earnings. So since earnings are volatile throughout the year and the business is seasonal in nature, you'll always see those companies trade at lower valuations. So that is why they trade at 15-20 times. Why do auto ancillary trade at only 20-25 times and not 50-60 times? Is basically they are ancillary plays. They are not direct, you can say again, brands. So they trade at 20-25-30 times. Even the best of auto ancillaries, if you pick them, they also trade there. If I look at endurance tech, for instance, with a lot of FII holding and all, and FIIs do like it, there the PE is around 40 to 43. This is because they are into a number of domains, into a number of sections and a number of geographies, and they have higher margin business. So here in the auto ancillary space, it is extremely difficult to analyze as to how the valuations are, because uh, you need to understand as to how the margins are panning out. Now here in the endurance tech case, or in this company, the margins are around 16-18%, 18%, 16%, 20%. And it's best of days when auto ancillaries were doing well. It was doing around 15 to 17%, you can say, margins. And if I look at say say a Jamna Auto, which I was talking about, the margins in here will not be around 17-18%. It would be much less than that. So if you look at it, 10%, 12, 13%. So it's all about margins game. If you look at it, between 10 to 13%, and they're 17 to 20%. And that's why different companies trade at different valuations in the auto ancillary space. You have to look at individually in order to analyze. But if you look at auto companies per se, like Bajaj or TVS or Hero, etc., they do trade at slightly higher valuations depending on how their numbers have been. For example, Bajaj's numbers have not been that great apart from the last quarter, and that is why it is trading at only 20-25, 20-22 times. Whereas TVS has produced decent numbers all throughout, you can say, last 2-3 years. It's trading at, if you look at, 40 times. So if you, the growth is there in a direct consumer play auto company, then you will see it trade at very high valuations, 40, 50, in some cases 60-70 times. You have an Aisha Motors, which is a brand in itself, an aspirational brand, that is trading at say 37 times, because the numbers have dipped. Otherwise, if you look at Aisha Motors from a PE perspective over the last uh, 5 years or so, it used to trade at 70 times as well. So I look at it here, if I can show you, during Jan 21 or so, when the market was peak, it was trading at 74-75 times. So it depends from company to company, but normally auto companies, they are reasonable in nature when they are trading at something like 25 times, 30 times. That's where you buy into them, and around 50 times, 40-50 times if you see it, you sell. So something like an iShare, 10% lower from here becomes a big buy because it will trading at 32 33 times. Being an aspirational like a stock, uh, you should give it some premium, and that is why more than 30 times is pretty reasonable for iShares. And you sell the stock around 60 70 times. That's the call on autos. Coming to commodities and textile, the last two sections of this video, and hope you, if you like the video, I put in a lot of effort in order to build this up big time. Do like the video and do subscribe to my channel. And if you have any queries, use the super chat super sticker feature. That will help me grow the channel, will help you also ask me questions and eke out answers in greater detail. So uh, coming to the last two sections, which are into you can say, let me see, metals, is it? So basically commodities and textile. Before that, I want to also give you an idea of biotech companies, healthcare, biotech, medical companies. For that, I have picked up something like Rosari Biotech. I feel Rosari as a stock, Rosari Biotech is one of the best in the biotech space. Trades at around 58 60 times. So normally pure biotech companies trade at higher valuations compared to pharma companies, although they are similar. Why is that? Basically, it is because that biotech goes into a lot of R&D, and D, and they come up with new innovations, better innovations, big innovations compared to any pharma companies, which are you can say manufacturing medicines for an erstwhile brand. Whereas in biotech's case, you have to come up with big innovations in technology and in biosciences in order to get benefits. And here margins are much more, much bigger compared to say any simple pharma company that I talk about. And so if you look at it, although last 2 3 quarters for Rosari Biotech hasn't been that great last couple of years, but you look at here in 2019, they were having margins of 19 20%, 22% even. In 2020, they had margins of around 22%, and so on and so forth. So in that sense, what happened was it does trade at higher valuations, and exactly the reason why something like Rosari Biotech is trading at higher valuations. Whereas if you look at any other, you can say, healthcare company also trade at higher valuation. Look at hospital brands and all. If I look at Apollo Hospitals, for instance, is trading at 70 times. So biotech companies trade, biotech, hospital, big brand companies, they tend to trade at very hefty valuations. Healthcare company 30 to 50, but even biotech companies can go up to 60 70 times if the business is good and if they are producing top level, you can say, results and profitability on the bottom line. Coming to commodities, this is an interesting breed altogether. uh, if you look at, and I have given you an example here of Tata Steel. uh, Best way to trade commodities is simple. In a very bad commodity cycle, you buy in negative PE and you sell at high PE. Now, why do people say that, and why do commodity stocks have very low PE even when the PE is high? So, getting confused. The point here is, normally, say a commodity, say a metal stock like Tata Steel. If you look at its numbers, let me give you an idea. So if you look at its numbers from 2011 till now, last 10 years, you look at it from 8900 crores in 2011 to 5200 crores in 2012. In 2013 it made losses, 2014 came back into profits, 2015 losses, 2016 losses, 2017 losses. uh, Okay, so 2017 we have losses, and from 2018 onwards it came back into profitability because of extraordinary, etc. And then we had the big commodity cycle from 2020. So what happened was, in 2013, I remember the stock was trading at close to 200 rupees, if I am not wrong, around 200 190 rupees. And I am talking of uh, pre-split. So let me just open up the charts here, that will give you a better idea. So in 2013, this is where I was talking about, August of 2013. the stock was trading at 20 rupees, 1920 rupees. So this is after splits, bonuses, and all. And from 20 rupees, the stock went to 146 rupees in August of 2021 when the big cycle started post the pandemic. So what happened was the stock, if you see optically, has gone up 7x. But see what has happened. So from 20 rupees in 2011, 2013 to around 26 rupees in 2020. In 7 years, it did 30%. In 7 years, it did 30%, which is around 3% on a CAGR basis, 2 3%. And then the big run. That is where the problem lies. So that is why these companies do not get a high PE, because you look at its numbers, you look at its bottom line, profits losses, all volatile in nature, and that is why the PE is always extremely low in something like a Tata Steel or in metal companies or commodities. Now the last part here is of textile, and then I'll take up your queries for 10 15 minutes as well. Ravi, thanks for your contribution. ICICI Bank at current market price for 5 years. Wait for all this to pan out. You'll get better prices. Probably you can buy 20% now, but wait for levels which is much, you can say, lower from here, and you'll get better valuations altogether. So do not rush to buy into the stock right now. Wait for declines to buy more into ICICI Bank. And yes, from a 5 year perspective, it does look good. So that's the call there. So in terms of textile, I have one example, and this is the last sector I'm going to let you know as to why the PE is lower and what could be the best PE. So in textile, in a sector like textile, normally the PE is extremely low. It's between 5 to 15, at best 20, 19, 20. If you have a very decent textile company growing decently, probably 20. But normally, if the PE goes below 5, 3, 4, 5, that's where you really buy into the stock, and the PE expands to 12, 13. That's where you start exiting the stock. This is the basic reason as to why I made this video, in order to make you understand as to what could be the PE ranges, and where the valuations could stack up in each sector, and where you could probably make a big amount of money. So in textile, it's between 5 to 15 normally, and in very good markets it goes up. So in phase 3, for example, the PE currently is around 12. uh, this is a company into branded textile that sells to majorly Europe, US, and also in South America. And the condition in Europe, US is not that great, and that's why the PE has shrunk here. I believe if you can get phase 3 per se at a PE of 10, that is where you need to really get into it. And that is exactly where people get misguided, that when the big run happened and the stock was around 435, if I can give you an idea of the PE of the last 3 years or so, uh, around those times of 400, 430, when the stock was trading at, it was trading at a PE of 25, 26. Now at that point of time, people talk about its growth being 20, 25%, and so the stock should trade at 40 times and all that. Nothing such thing, or nothing of such sort happens. In fact, uh, who are intelligent investors and who have bought into at a PE of say around 8 or 9 earlier, say 1 year back or 2 year back, start booking profits. And that is why eventually what happens is PE shrinks, although the company does well, company and the results are fine, but the PE shrinks, and we have the average PE, and screener gives you an idea. So the average PE for each sector is given here. 12 is what the average PE here is, and it is trading at 12. So it has come to that average PE. Wrote any dips with a PE of around 11, 10 is a very good buying opportunity if the market falls more. And again, now this time around, you know about what is happening. So again, when the stock trades at 25 times, and the earnings will expand too, so whatever EPS is in FY22, it won't remain the same. So FY21 was around 21 rupees, this time around it will be around 24. So again, earnings will expand in a couple of years, and the PE expansion will take place, and that's where the stocks go up to 3x. So so you need to understand in textile why the PE is so low, why the PE is not 30, 40. Normally I've seen over the last 10 years what has happened is 10, 12 years, textile is a sector never have a PE, never. At least this, I don't use this word for any sector, but here I have not seen textile on a very consistent basis trade as a sector at around say 30, 25, 30. So you look at industry PE, the industry PE for textile is around 15. You have to compare with the industry PE, simple, and see as to how the PE of the stock is currently, and you'll understand as to whether you need to really get into the stock or not. So they don't, the PE of the sector do not cross 20, even 2025, let alone 30. And the reasons for that are many. Government interventions, there are many government laws. You have export bans, then export, you have tariffs, some agreements in which tariff agreements in which you probably import products at slightly lower rate. Next year you'll have higher rates for the same. You have fluctuations of the currency because you're working in Europe and US, so pounds and dollars, they keep changing according to your currency. So your whole economy, if it goes into tailspin, then your currency drops here in India. If the European economy drops the way it has happened over the last 1 year, the war or the escalating situation in Europe has had a bad effect, extremely bad effect on or a detrimental effect on businesses in textile. So these things do affect directly such companies, and that is where one needs to be careful, and that is the biggest reason as to why textile as a sector do not trade at P of 30, 40, whereas consumer, if I come back to this presentation, consumers do trade at 50 times, again even 100 times, because people are sure about what kind of numbers we are looking at, and numbers could go up very quickly. In fact, one more thing I want to add here is that consumer companies, uh, whenever inflation rises, they make even more money. And let me know in the comment box, why do they make more money? Say Nestle's and Daburs and HULs of the world, why do they make money? Even white goods companies, and that's why they trade at higher valuations compared to any other sector. So because you have an understanding as to what the numbers could be going forward and how the growth will pan out, and there are very little or very few things, one or two things that could affect that number drastically. So this was basically a video to make you understand as to how, in my opinion, valuations stack up. Now I'm ready to answer your queries. Kindly use the super chat and super sticker feature that will help me grow the channel. That will help you ask me questions and eke out answers in greater detail. All right. Uh, what are the queries that have come in? Okay, so yes, so banking finance is something I don't track, but there again, because of a lot of loophole, a lot of issues that take place, I believe banking finance as a sector, trade cannot trade more than 25, 30 times in terms of earnings. So kindly check in your, you can say, with your companies as to how the PE has been for that company at the moment. Okay. Sheetal has come up with a question. Kilpest withdrew the proposed acquisition of a European company. People getting skeptical if they have really have the money as shown in balance sheet. I don't think that is an issue. I believe personally that the company is pretty good. The management is pretty decent and honest. There must have been some reasons business wise as to why they have not gone ahead with the acquisition. See, if they did not had the money altogether in the balance sheet, they would not have announced such a thing uh, at all. They would have just gone ahead with the numbers and all. And there are many other ways of you can say tinkering with the stock price, etc. If you're talking on that front, and neither the promoter has sold at say 480, 490. In fact, they have been buying, or the director has been buying at 400 levels as well. Even he has bought at 450 levels. So I don't think that is an issue. The issue is, yes, they should go for an acquisition or a fat dividend altogether with the kind of cash they are sitting on. I would love to see them buy something big in Europe or US, but we'll see, we'll wait it out. Okay. IT ETF, Pharma ETF. See, ETFs are good. See, IT Pharma, you look at 15% CAGR for 14%. If you get that, you'll be happy with that. So that's what you get. But I believe in looking at or buying into stocks which could give even better, you can say, returns going forward. Nika and Kilpest at present level. Kilpest around 400 is good. If you get a chance to buy around 400, 410, looks good from a 2 year perspective. Nika, yes, looks attractive now. 120 to 130, one can accumulate 2 to 3 year time frame. Nika can end up doing pretty well. So that's my call there. Okay. What else? So Asian Paints at current market price is a buy. I think from a 3 year perspective, it's a buy. I don't see major downside in there. I think most of the pedigree stocks would have made a bottom on Friday, and you will see buying into defensive stocks like Asian Paints, etc. Going forward from here. So that's my call on Asian Paints. The equity is taking beating with different reasons. Buying gold is better. You can probably, Ravi, you can buy gold or probably into fixed income for a year or so. I think you can probably get it in fixed income. If you're not sure of specific companies as to what to buy into, I think it's better to get into gold or fixed income in that sense from a 1 year perspective. Mastech very positive. I've talked about it, Sagar, earlier as well, that I believe around 1600. Very decent. Again, go back to my presentation which I was talking about. IT trading at 16 times is a buy. Mastech is trading at 16 times. It is a buy. You can have uh, one bad result and stock will fall more, but there is greater margin of safety. Root Mobile, very decent numbers, but I'll wait for one more, you can say, result, one more number, and then probably take a call on Root Mobile. I don't have a budget pick as such because I feel that next 1 week could be even more volatile in nature. I would suggest that avoid trading for the next 1 or 2 weeks and let this market settle down first, because there's major issue that is happening apart from the budget and we all know about it. So that's the call. Vankeys is a hold. I think hold for a year, year and a half. You'll make decent money, but have a stop loss in place because it's an extremely volatile company. So in that trend, a stock, so probably a 10-12%, 10%. You can say stop loss from current levels, and we'll see how things pan out in the next 1 year. Reliance is a buy at these levels. That's my call on Reliance. Thank you. Thanks a lot for being online. Please like and subscribe my channel. Hit the bell icon so you get my video straight away when I post it. And kindly do support me on Patreon. Thank you.